Welcome to the Money Rules Podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Today we're tackling a common dilemma, choosing between two popular investment options, unit trusts and real estate. Both have their merits and drawbacks, but which one is the better choice for you? Joining us to discuss this further is Devon, who is a certified financial planner at Crue Invest. Welcome to the show, Devon.
Hi, Tumi. Thanks for having me.
To start, could you provide a brief overview of what unit trusts and real estate investments entail?
Sure, of course. So, I think it's quite easy to explain what a real estate investment is. Very simply, that's the purchase of a property, whether it's industrial, residential, or commercial, where someone invests in a hard brick and mortar asset to benefit from capital growth and rental income. Where a unit trust is, probably the most common way people go about investing nowadays, where you invest through what is commonly known as a LISP platform, where these LISP platforms will have a whole array of different unit trusts that investors can invest in, where basically you buy units in a fund, and they normally have fairly low barriers to entry with the minimums that you are required to open these accounts. And investors can choose from investments either local or offshore, income funds, bonds, property, or equities, or a combination of these kind of assets, depending on what type of fund choice they select.
Let's discuss some key points to consider when comparing the two options. Firstly, liquidity. Why should investors have this top of mind?
Yeah, so this is probably the most important point to consider. It's the whole liquidity conversation when it comes to these types of investment choices. So in a unit trust, you have what we call complete discretion, where investors can invest either via a monthly debit order, they can do ad hoc contributions, and just as easy as it is to get money into the investment, it's as easy to get money out. You can either set a regular withdrawal where it pays you out on a monthly basis, or you can just do an ad hoc withdrawal where it's obviously not instantaneous, but a couple of days turnaround time. And whether it's the entire fund or a portion of the fund, you can have released into your designated bank account. Whereas a property, obviously, it's a little bit more complicated than that. Once you've invested in the property, the liquidity that you have is fairly limited. You obviously have a monthly cash flow, however you've structured your rental agreement with your tenant. The concern and sometimes risk that comes in there is, if your tenant pays on time, monthly costs associated with that property as well. So that's got to be taken into consideration. And if, as the investor, you need access to funds, there's no way to sell off a portion of your property. The entire property would have to be sold off for you to get your cash out. You can't chip away a few bricks if you need to cash in a little bit and pay some bills.
Devon, another aspect is diversification. How does this compare between the two investments?
Yeah, so as I mentioned earlier, when it comes to unit trusts, the investors have a whole range of options. You can go quite specialized. You can invest in 100% property fund, for example, where it's all listed retail property or commercial property as an example. But even in those funds where it's focused in one specific asset, you're going to have diversification, because that fund is not going to invest in one property, for example. It's going to be invested in multiple properties around various countries around the globe. And you can go as diverse as what we would call like a balanced fund, where you have some cash, some bonds, some property, some equity, again, diversified across both local and global in various different property shares and income generating assets. Whereas a property investment, a real estate investment, obviously you are now hyper focused and not diversified at all, because you're going to be investing in one single asset, one single property in one very specific geographical location. So it's not to say that that's going to deter from your return, but obviously the risks are just that much higher where you're so super focused and you don't have much diversification.
We'll get to some of the risks later on. But what are some of the key considerations for investing, the key tax considerations?
Yeah, so like with anything, There are taxes to be paid in various situations regarding what investment you make. So if we use the real estate investment option first, so the taxes applicable there, your rental income, your rental yield is obviously seen as taxable income. So that's income that you're going to have to report to SARS and pay income tax on. The other tax that you need to consider is what is known as capital gains tax. So your capital value of your property, one would hope, would increase over the years while you hold the property. And one day when you decide to sell that property, the difference between what you purchased the property for and what it's worth now, if you've had a capital gain, that's going to have to be reported. There's a certain calculation that goes on behind the scenes, and a portion of that gain is going to be included in your taxable income, and you'll have to pay tax on that. When it comes to a unit trust, it depends on what type of asset class you decide to invest in. If you invest in cash and bonds, those assets are interest bearing. So if you're earning interest in those funds, if you cross the threshold of your annual interest-free amount of 23,800 for anyone who's younger than 65 years old, you're going to have to add that amount to your taxable income. And again, you're liable for income tax. And then when it comes to equities, it's much the same as the capital value on the property. There's capital gains tax that you need to take into consideration. So if you sell any units or there's any switches that happen inside the fund, that's seen as a capital gains tax event, where if there's any gain being realized, depending on the calculation, if it's above the annual abatement of 40,000 per year, there will be certain taxes applicable to that. And if you invest in property as an asset class in your unit trust, they call it REIT, Real Estate Investment Trust. That also gets included in your tax return, much like a property investment. You know, if it's generating certain rentals and income, there's taxes applicable to that as well. And then within the unit trust, especially on the shares side, there's dividends withholding tax. So if there's dividends that are being generated by the shares that you hold, the service provider that you invest through withholds 20% withholding tax for those dividends, and they pay it directly over to SARS.
Let's talk about costs and fees. Unit trusts typically charge management fees, while real estate investments involve expenses such as property acquisition fees and maintenance costs. How should investors factor these costs in when evaluating their options?
Yeah, so the great thing about unit trust through list platforms is that these are quite transparent. So with any unit trust investment, there's typically 3 fees involved. One, it's your admin or platform fee. So that's the service provider you decide to invest through. They're going to charge you an admin fee, and they'll disclose the percentage up front. And normally that fee scales down the more funds you have invested on that platform. Then depending on what fund you choose to invest in, that fund's going to have what's known as an investment charge. And these fees are all disclosed on all the various fund fact sheets that you can go through when making these choices. And then the final fee is if you have a financial advisor. Most common practice is that financial advisors will have an advice fee that they disclose with you up front that you agree with, and that will be placed on the investment as well. All of these fees are percentage based. So very simply, a percentage of your fund value will be used to pay fees, while obviously you hope as the investor that your fund that you invested in is growing by more than what you're paying in fees. But it's quite clear and transparent. On the real estate side, so there's a few things to consider. So obviously you have your ongoing costs and fees. So it's maintenance, it's then insurances. If you have a managing agent looking after the property as well, they normally take a fee as well. It's obviously the monthly taxes that you have to pay on the rental that you yield. But the fees that are often forgotten are what we call the sunk costs when it comes to a property. So that's, the fees that you pay to the conveyancer when you're purchasing the property and doing the transfer. You need to change the carpeting or put new windows in or give it a new coat of paint. That's not necessarily going to add value to the property, but that's going to be an expense that you're going to have to outlay that is often not taken into consideration when looking at, the value of the investment and what that yield's going to be from that investment.
Devon, for those leaning towards going the property route, how can they calculate the net return on their investment property?
So much like what we just discussed now in the fees, basically when you're looking to make an investment, what we're looking for is a return, otherwise known as your yield. So it's your return on investment, and it's often disclosed as a percentage. So there's this, I don't want to call it a myth, but there's this general feeling that, because you invest in property, you have capital value and you have a rental income, it's the best way to invest and get a return. And there's a general feeling often that it's better than like a unit trust, for example. But to really work out what your net return on your investment is going to be, it's quite simple to do. And most financial advisors will have built some sort of spreadsheet to help their clients really analyze this information. And very simply, what you're looking at doing is saying, okay, well, there's obviously an outlay, a capital outlay for the property, and that's your investment value. And your return on your investment is going to be made up in two parts. One, it's the rental income that you get, but now you've got to minus the tax that you pay, the insurances, the security, the tenant, the monthly agent fees that you have to pay, the maintenance that you have to do. Something that's also important when you're forecasting those long-term yields is you need to take tenant risk into consideration. It's very difficult to assume that someone gets, 12 months rental income on a property in perpetuity. So common practice is to assume you get 11 or 11.5 months of rental income on your property investment. And when you take all of that into consideration, you get a percentage yield on your property, and then you've got to add in what your capital appreciation is going to be on that property. And of course, where you invest will affect what that capital yield is going to be, the property value. But common practice around the globe, and the history shows us this, is that on average, property globally as a capital value will keep pace with inflation. So basically, you're going to get to your return on investment being inflation, which is your capital value in your property, plus the percentage yield that is your rental income net, all those fees.
Devon, both unit trust and rental property come with their own set of risks. I know you touched on liquidity risk and tenant risk for property. So how should investors evaluate these?
Like with building any financial plan or portfolio, you can't look at it in isolation. We've touched on all the risks. So to maybe pull in my last point I made about that net return. So normally what happens is once you get to that number where you see what your net return on that investment is going to be, you need to say to yourself, okay, well, am I willing to take the risk of owning a property, having tenants in, running the risks of having a single asset in a single area for that return? But you need to take your whole portfolio into consideration. It could be a situation where, you have other investments elsewhere, or you have other property elsewhere. And if you're already exposed to a lot of property, whether it's via your primary residence or a holiday home, and now you start investing in real estate as well, and you start looking at that overall distribution of your assets, and you see that you're quite overexposed to property, you run the risk of, if property goes through a slump, like we've seen it do in the past, you run the risk of having a lot of your portfolio exposed to that downfall. But much the same as investing in a unit trust, it's not to be done in isolation. Look at your overall asset distribution map and see where you can find more diversification, and that, combined with the associated risks of each one, should ultimately lead you to making a well-informed decision around whether you can appetite the risk of either the unit trust or the property portfolio.
Devon, can you maybe give us an example that perhaps illustrates the possible returns each asset class can offer investors?
Sure. So, it's always difficult, as a financial advisor when clients say, okay, well, what is the return going to be on this unit trust, or what's the return going to be on this property? And while the phrase, you can't look at historical returns to forecast future returns is very true, all we can do is look at what those asset classes have done historically to help us have an idea of what to expect moving forward. And when we look at what history shows us, if we look at the four main asset classes, cash, bonds, property, and equity, there's a trend around each asset class in terms of long-term expected returns. And very simply, cash is going to give you inflation-like returns. Bonds are going to give you inflation plus maybe 1 to 2%. Then when you move into your growth assets like property and equity, historically, property around the world yields somewhere in the region of inflation plus 4 to 5% on an annual basis, whereas equity yields somewhere in the region of inflation plus 6 to 7%. So, having run multiple calculations for clients looking at a property as an investment, it's quite nice to see that when we take all of those considerations in and trying to work out what those return on investments are, we tend to see that theme pull through, that if you've got fair value for your property and you've got fair value for your rental, the return on investment tends to be somewhere around inflation plus 4 to 5%. Of course, it varies depending on what your income tax bracket is. And then obviously in the unit trust, it all depends on what asset class you're investing in. If it's pure equities, you should expect inflation plus 6 to 7. If it's a combination and more like a balanced fund, you'd probably sit around that inflation plus 4 to 5% as well.
Would property unit trust be like a happy middle ground between the two?
Yeah, so it's always the reference we make. So if you want to invest in property and that's something that you want to do, but it's not necessarily you trying to build a property portfolio, but you believe that property is where you want to have your wealth, it is extremely risky to invest in a single property in a single geographical location. So investors can take up the option of investing in what's known as a property unit trust, where you have the combination of exposure to that asset class, but also the benefits of the unit trust flexibility, where you can access your funds easily. It's transparent, and you're not exposed to just one property, but a whole arrayment of residential and commercial properties. So across both local and global geographical locations as well. So yes, I would say that's probably a happy middle ground for someone looking for property exposure, but alleviating that risk of having a single real estate property investment.
Devon, just lastly, what advice would you have for investors grappling with deciding between which path to take?
So the advice I would give is try and make the most informed decision possible. And the only way to do that is to have all the information that you can at your fingertips, and to not only do the analysis once, but it needs to be an ongoing analysis. So property values change, rental agreements change, market conditions change for equities. So when making these types of decisions, it's important to engage with your financial advisor, bring forward all the information, and your financial advisor is not going to tell you that there's a right or a wrong answer, but they're going to go through exactly what we went through today in all the questioning that we've done. Help you understand the risks associated with each decision, what you should be able to expect, as a long-term return from each option, factor in what your overall financial plan looks like, and then ultimately get you to a point where you can make an informed decision, one that you don't have regret later on. And it's often the case where you might make a decision that's informed and it's right, but it could be different in 2 or 3 years' time. It might, the property market might change, or the investment market might change, or your financial situation might change, where you need to make an adjustment to your retirement plan and your financial plan.
All right, thank you so much for joining us on this episode, Devon.
No, absolute pleasure. Always good to be here.
That was Devon Card, who is a certified financial planner at Crue Invest.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.